Wonderful.
All right, there we go.
Awesome. Thank you, Brian.
No problem.
Great. So good evening, everyone. Welcome to tonight's ITKAN session. Definitely excited to continue on the conversation you had last session about cryptocurrency and some broad strokes on NFTs and Web3. Tonight, diving a little bit deeper, comparing cryptocurrencies and traditional currencies. So this is a bit more focused on that initial use case of Bitcoin, which is really to be that internet of money. So today we'll examine both the benefits and drawbacks with a bit more of a balanced perspective, but I will lean into some more of that Bitcoin maximalist perspective as well, where more folks have maybe put their money where their mouth is, and have started to invest either their own personal wealth or treasuries for the companies and organizations that they work for. I've also peppered in a bit more recent or tangentially related news regarding tariffs and just the current ongoings of the Justice Department and their whole crypto unit and news around that as well. So let's get started. So let me introduce myself first. I'm Chris Mendoza. I'm a senior strategist with experience working at the intersection of technology and finance. What that means is I really deal in the art of what's possible using things like blockchain technology, but more recently in my role, I'm exploring augmented reality and the worlds of mixed reality. Before we start tonight, I do want to emphasize that the opinions that I share are all my own, don't represent ITKAN, don't represent the organizations I work for or affiliated with. And nothing I discuss today should be considered financial advice. Suggest to consult with any qualified financial professionals before making investment decisions. The big acronyms that are typically thrown around in crypto are NFA, not financial advice, or DYOR, do your own research. And there's plenty of research out there, and I'm happy to recommend a lot of great profiles and folks to give a follow to as well. Also like to note that while cryptocurrency has unfortunately become this really increasingly politicized in the more recent months, I will be trying to make a more concerted effort to keep the topic a bit more nonpartisan. So one of the folks that I follow pretty closely is Andreas Antonopoulos, who has noted that this isn't, when you think of Bitcoin, it isn't a libertarian currency any more than it's a communist currency. It's really purely a currency, and it can be applied to any political system, whether it's a political system you like or you don't. So today's session really builds directly on those fundamentals that were covered in the last session, as well as comparing those benefits and drawbacks between those traditional currencies and crypto. So my goal again is to really provide that balanced analysis to help you both understand both systems a bit better, while sharing a bit more of that maximalist or Bitcoin maximalist perspective as well, which is really driving that excitement in the crypto space and more recently politically. So here's our agenda for tonight. We'll start with the evolution of money, which I know you touched on a bit, and examine the global monetary context that gave rise to cryptocurrencies. We'll analyze both the strengths and weaknesses of traditional currencies, followed by the pros and cons of crypto. I'll share some perspectives from Bitcoin maximalists like Michael Saylor, of Strategy, formerly MicroStrategy, as well as explore some more real-world applications of both those systems. We'll look at future projections and then conclude on how you all can make some informed choices in this very complex and changing landscape. We'll save some time for questions as well.
Good.
All right. So let's begin by understanding how money has evolved throughout human history. This is a very condensed illustration view spit out by AI. So money serves really those three functions. It's a medium of exchange, allowing people to trade goods and services. It's that store of value. And it helps preserve that purchasing power, hopefully preserve purchasing power over time, and then serves as a unit of account for consistent trade and barter. Money began really as this barter between individuals, which was inefficient because there's that coincidence of want. This evolved to commodity money like shells and beads, and eventually precious metals like gold and silver. And then next came representative money, paper certificates that were eventually backed by gold until a critical turning point in 1971 when, yeah, the US broke that link between dollars and gold, which created the modern fiat currency that we have today, which is money that is backed by government decree and that collective belief. So recently, you may have seen countries like Japan or China selling U.S. bonds, which may be a signal or indication of, yeah, a a lack of belief in the future of a certain economy. So now that we're witnessing this next evolution, a more digital native money that's secured by cryptography and consensus, as opposed to governments, um, we want to note here with the quote that I have in the corner, which is that Bitcoin is not just another asset. It's really simultaneously serves as an ideology, protocol, an asset, and a network. And so that's something that we want to dive a little bit more deeper into is this multidimensional nature, which helps explain why, yeah, Bitcoin represents more than currency or just an investment vehicle. Yeah. The question?
Hi, my name is Nisag. Just out of curiosity, does fiat mean something?
Right. Yeah.
And
So yeah, fiat is effectively money that's like a certificate that can be exchanged. So like a dollar or a peso, which is backed by a government, would be a representation of fiat currency.
oh, thank you.
Absolutely. Right. And so diving a little, so if we're looking at this chart here, you go through all of those different means of exchange, but something that's come more into conversation is around global reserve currencies. So this chart here is really fascinating historical perspective on reserve currencies over the past 800 years. Something I think that's notable that is a bit more notable when you look at the chart here is that there's an accelerating pace of change. Earlier reserve currencies lasted for centuries, while more recent currencies have lasted for increasingly shorter periods. The current US dollar-based system, established at Bretton Woods, has only been the global standard for about 80 years, and in its current form, without a gold backing since 1971, so about 50 years now. What we're experiencing with Bitcoin is pretty fascinating in the fact that it's gone from this novelty magic internet money that was exchanged for maybe more nefarious things and as like a proof of concept in 2009 to more truly store of value. So we'll start to take a look at how other countries, organizations, and financial institutions are also looking at Bitcoin these days. Take a look at my notes here. Yeah, so when you look at the monetary history from a more long-term perspective, the idea of a digital decentralized currency taking on aspects of a reserve currency role doesn't seem maybe as radical as it might at first. So just looking at this historical pattern of monetary evolution, I wanted to just point out that it's often in response to technological or social change. All right. So to understand the problem that cryptocurrencies attempt to solve, I like thinking back to this analogy that an investor, Preston Pish, has shared a number of times, which looks at the game of Monopoly. Basically, imagine multiple Monopoly tables being played in a room. Each table has its own banker that controls its money supply. Players at each table can buy properties from other tables. But what happens in these types of scenarios? Players whisper to their bankers, if you print more money for us, we can buy more scarce properties from other tables. Without a fixed monetary standard that governs each of these parties, there's really an incentive for each banker to perhaps print more money. And that's what we like to call, I guess, in this crypto circles, this race to debase, where we see global currency markets headed. If one table refuses to print extra money while others do, who ends up with the most desirable properties? The tables willing to debase their currency often end up being the winners in these scenarios. And you can run these scenarios through AI models or large language models, and it's interesting to see it play out with respect to different fiscal or monetary policies, and then what's programmed into Bitcoin's just set $21 million supply. So this analogy is really intended to illustrate what happened when we abandoned the gold standard in 1971. Without an external anchor for the monetary system, nations started to compete to debase their currencies, creating distortions in the global capital allocation. So Bitcoin represents a potential solution, really, a monetary system outside the control of any single government or entity with a fixed supply that can't be altered or arbitrarily increased. All right, so more on this race to debase. So since 1971, we've seen nations competing to debase their currencies. Central banks around the world continually expand their money supply, ostensibly to manage economic growth and stability. This creates a game theory problem where all participants are incentivized to debase their currencies to acquire scarce and more desirable resources. We have Michael Saylor pictured here, and he's been very vocal about this dynamic. He made the very bold decision back in 2020 to convert all of his company's treasury to Bitcoin. It seemingly has paid off, but yeah, he just continues to effectively make his dollar cost average approach to buying tens of millions to billions of dollars of Bitcoin on a weekly to bi-weekly basis. And his bet is really that he can preserve value better than dollars in the current environment, where folks are really competing to debase currencies. So far, that's paid off. But yeah, do want to continue to explore what this looks like as more nation states have started to take notice of this store of value and ability to leverage Bitcoin as a means to also secure and transfer funds. So this most recent news this past Tuesday illustrates this race to debase concept. China has really started to has entered this trade war with the U.S. to restrict exports of any rare earth metals, really critical components for us to be able to build things like smartphones and electric vehicles if we were to bring production stateside. And when countries control scarce or valuable resources, they gain leverage in the international economic arena. So China, who dominates rare earth metal production and can restrict these exports, is using this control as leverage against other nations. And this impacts, the certainty that folks have in their reserve currencies. And this event also highlights why Bitcoin, with its more absolute digital scarcity, appeals to many as that alternative monetary system. So unlike rare earth metals and minerals, which are physically constrained and geographically concentrated, Bitcoin's scarcity is maintained by its protocol, regardless of geographic location. Now we'll start to examine a bit more of the genuine strengths of traditional currencies, the tried and true currencies like the US dollar, the euro, Japanese yen. I think it's really important to acknowledge these advantages that they explain why these systems really have remained dominant, despite some flaws or loopholes, rather. So first being stability and predictability. Despite inflation concerns, major fiat currencies typically fluctuate within a much narrower band than cryptocurrencies. We'll look at some more recent news after this slide. But yeah, for the most part, there's less volatility. And the stability makes traditional currencies more well suited for everyday transactions and business planning, contractual details, things like that. As opposed to Bitcoin, which can fluctuate 5 to 10% in a day, or in a given market cycle, up or down 80%. Second, being universal acceptance. You can use dollars virtually everywhere, whereas cryptocurrency is not globally accepted yet or accepted across payment systems, though that is also changing. There are consumer protections as well, where you have institutions like the FDIC, which will insure you up to $250,000. So these protections really create that safety net, which make people a little bit more self-assured in their investments. There's also regulatory clarity, so more established legal frameworks around traditional banking. When disputes do arise, that there are clear procedures that exist for resolution. And even things like the Silicon Valley Bank collapse. So despite being a major bank failure in 2023, all the depositors were insured and protected by FDIC through government intervention. All right, so some traditional currency drawbacks. I think the most obvious one here is inflation. Inflation's been in the news lately, and I think it came in a little below what was expected at around 2.4% recently. So inflation is typically viewed as a negative because it erodes the purchasing power of folks that are invested or saving money over time. So in just the past few years, the dollar has lost substantial purchasing power. Central banks target around that 2% area typically for inflation, which means that money loses half of its value roughly every 35, 36 years. And that's by design. That's not by accident. These monetary policies are intended to keep global trade functioning and to ensure that folks are able to make do when there are treasury and bond commitments. So this leads to that second weakness there, which is government control. Central banks can create new currency units at will. You might hear this as quantitative easing. So as we saw during the pandemic, the Fed increased the money supply by about 40% in the US in just 2 years. So this ability to manipulate currency is often seen as a weakness, but can also help in the case of managing economic crises. I think it depends on the view and which side you are on in the case of taking a buy or put position in these types of investments. And third is the exclusion of the unbanked. So there's approximately 1.4 billion adults around the globe that do not have access to banking services. Even in the US, I think that the numbers around 5.4% of households are totally unbanked, meaning that these people face barriers to participating in the economy, paying higher fees just for basic financial services. Related to that is just the high cost around international transfers and cross-border payments. So cross-border transfers through traditional banks typically are slow and expensive. For just like as an example, if you're sending money to the Philippines, you typically have to pay, or from the Philippines to the US, you'd have to pay a fee to convert your Philippine pesos to a stable currency, whether that's the US dollar or euro, and then back to the destination currency. So you can incur anywhere from 5 to 20% fees on remittances, which really impact immigrants who are working abroad. We have one real world example here. So the Turkish lira has lost about 80% of its value against the dollar in recent years. Lebanese pound also collapsed as well. Venezuela experienced a bit of hyperinflation, which also caused their currency to be virtually worthless on like the global scale, but also purchasing of imports. So that's the reality for millions of people in these unstable monetary regimes. So just a quick view of that 2% inflation and that half-life of your purchasing power. So if you start with $100 of purchasing power, just 2% inflation at that rate, yeah, you'll have about $50 worth of purchasing power in about 35 years. So yeah, just looking at the compounding inflation, it explains why some Bitcoin advocates are so passionate about its more fixed supply and it being potentially deflationary with the fact that there's only so much Bitcoin and folks have a lot of Bitcoins also lost, just locked up in wallets that cannot be recovered. Right. So more of this Bitcoin maximalist perspective. So according to Michael Saylor's 21 Truths of Bitcoin framework, Bitcoin is not just a speculative asset or digital currency, but something a bit more profound. So you may have heard people describe Bitcoin as digital gold, but he takes it a step further, saying that it's not just a metaphor. He argues that Bitcoin is nothing more than digital gold. If it wasn't just digital gold, it'd be worth 200 trillion, which is 10 times the value of physical gold, because everything digital in our modern era is worth 10 times the analog version. He refers to Bitcoin as the perfect money, something economists like von Mises or Hayek wouldn't or couldn't conceive of because they lack the technology. Bitcoin represents the first truly perfect money because of its absolute scarcity and the inability for it to be manipulated. He describes Bitcoin as being immortal because it's designed to last centuries, unlike companies or traditional assets. He asks, what company would you think is going to be around 200 years from now? And by contrast, Bitcoin is designed to function really indefinitely. Perhaps, maybe the most intriguingly, he frames, yeah, you have a question? Hey, Pat.
Yeah, thanks, Chris. Can you explain the rationale behind digital currency having a 10x value premium over traditional?
Yeah. So the argument here that, and I'll put on my Bitcoin maximalist hat, is really that Bitcoin's public key cryptography and the ability that you can trace any transaction across the blockchain and have that transparency, but also obfuscate transactions, provides more value than that of gold. So gold's value physically in industrial applications is less than the value that it's assessed for the how do you say this, like jewelry or other uses as well. So we know that it is difficult to mine gold, and part of that it's difficult to mine gold, and gold is scarce. And the way that Michael Saylor looks at this is that he applies this digitally as well, where there is also a quantified amount of energy used to, say, mine a Bitcoin, and that the value brought by the blockchain is 10x that of gold. Like he would basically argue that Bitcoin brings more more value than gold, and because it can be quantified and is quantified monetarily in code to just produce that 21 million units, that the fact they're just saying that outweighs the value that gold produces, where it can still be found and mined, where a country like China has just mentioned that they've found a mine. It's not mined gold yet, but approximately $3 trillion of unaccounted for gold. So the fact that this is more fixed of a asset class is where he's deriving that value. Yeah, so let's see here. I think the last bullet around digital energy is pretty interesting, where and gets at that gold comparison as well. So he frames Bitcoin as digital energy, where a Satoshi is that smallest unit of Bitcoin, is comparable to a calorie of organic energy, where this conception allows Bitcoin to bring life to cyberspace by implementing conservation of energy principles in the digital realm. So there's been this race for folks to mine Bitcoin, and it's only been profitable for folks to mine Bitcoin where energy is abundant and less costly. So there's been folks using geothermal energy through volcanoes in El Salvador, or solar energy to power their mining rigs. And at the moment, I think as of the past quarter, Bitcoin has now moved to around 56% renewable energy powering its mining operations. So I know that's also an area that folks point to cryptocurrencies as being wasteful, very wasteful, similar to AI in terms of compute and everything. But for something like Bitcoin, which sets it apart from other cryptocurrencies that uses this proof of work where actual energy has to be used to solve and mine calculations on the blockchain, I think this is something that sets it truly apart from some of those other opportunities out there in other currencies. Great. So let's examine what really makes cryptocurrencies shine. And when I say cryptocurrencies, again, largely looking at Bitcoin in the long term, whereas yeah, there are a lot of opportunities with other currencies. I can talk your ears off in the Q&A about all the different coins and things that I've been involved in or have invested in round trip and all that good stuff as well. So really here, the primary strength is decentralization, where there's no single entity that controls the network. Bitcoin operates without any central authority, making it resistant to censorship and political manipulation. No one can freeze your Bitcoin wallet the way a bank can freeze your account. I thought it was interesting about gold. When gold was seized, the majority of the gold that was seized actually was from custodians and not directly from people or anything. So this is another important lesson in cryptocurrencies, is that you should really do that extra step of self-custody, because a lot of what you hear in the news about people losing their cryptocurrency or being on that losing end is due to them keeping their funds or their money on an exchange or some other nefarious way, of whether you use like a wallet that's a browser extension. So it is important to keep your money and yeah, be safe with your seed phrase. So Hawa asked a question about hackers creating code to manipulate the blockchain. This is something that would come up early in Bitcoin's adoption, where there was this concept of a 51% attack, which was, what if we can get 51% of the participants in the blockchain to agree to come to a consensus? So blockchain is really driven by consensus mechanisms. So everyone that is hosting Bitcoin comes to an agreement. And there was one point in time where someone could come up with all of the compute power to stop the Bitcoin blockchain. Right now, because again, Bitcoin is proof of work, you would need to harness the power of the sun. The other comparisons I've seen is all of the compute power of NVIDIA, Microsoft, Meta, Alphabet, Google, all combined could potentially stop a block or put an incorrect block on the Bitcoin blockchain. But that would quickly be reversed by people coming to consensus on that very next block and saying, let's move to this this other blockchain that we all agree is correct. So I don't think there is, at least with Bitcoin, there's no potential bad actor, even with a quantum compute scenario at this moment, with what's known about quantum computing and those chips, that there could be a full out 51% attack on Bitcoin. And that's what makes it important too. So that next point of it being borderless is that Bitcoin doesn't recognize any national boundaries. Most cryptocurrencies don't either. It's usually the platforms that are trying to be compliant that would have something like a know your customer KYC functionality. So you can send 100 million in Bitcoin across the world for under $10 in fees, and it will arrive in minutes rather than days. So the efficiency and value transfer is really revolutionary. I don't know if anyone's tried to send or wire even over $10,000 or close on a house or anything. It's very challenging and has to be well orchestrated, or it cannot be done. The next part here is it's programmable. So particularly with platforms like Ethereum, or recently in the past couple of years, Bitcoin as well, smart contracts allow for automated trustless transactions. So basically, if an event occurs, then you can pay out. So you can have these automated escrow situations that are programmed without the potential of censorship, fraud, or third-party interference. So just if a set of events occurs, then money is paid out, basically. So this allows folks to reinvent everything from insurance to real estate transactions. That other part is around transparency and auditability. So every transaction on Bitcoin is on a public blockchain. It's visible and verifiable by anyone. This creates really unprecedented transparency. It would make maybe Doge's life a little easier. But yeah, even then, folks like Senator Loomis is pushing for the US to be upfront with their cryptocurrency holdings. So right now we know about all the cryptocurrency that's been seized from like Silk Road and other drug busts and the like, and that's going to be moved to more of a strategic Bitcoin reserve. But yeah, there's currently no plans for the US to purchase Bitcoin, but you would be able to see it because of the transparency of the chain. Weaknesses. So there's certainly a lot of challenges as well. Again, price volatility is a big one. Just before the new year, Bitcoin was over $100,000, and now it's hovering around 80. But yeah, this is given all of the macro environment and everything that's happening politically around the world. So it's experienced multiple cycles of 80% drawdowns, but those are also met with all-time highs, and these typically come around those 4-year halving cycles of Bitcoin. Michael Saylor would argue that the volatility is a feature, and the fact that cryptocurrencies are on 24/7 allows folks to capitalize on these volatility moments, and that's something that his strategy organization has done with their treasury. So volatility makes cryptocurrencies problematic, maybe as a unit of account for everyday transactions, but in the long term has proven the contrary. There's also some scalability challenges because of the amount of folks that need to reach consensus for change. Major blockchains like Bitcoin and Ethereum have a limited throughput due to compared to traditional payment networks like Visa or MasterCard. And so folks have built solutions on top of these protocols or platforms that help to address some of those concerns. And those would be called layer 2 solutions. So you may have heard of things like Bitcoin Lightning and these agreed upon add-ons that really help to mitigate some of these weaknesses. So let's see, third, technical barriers. Using cryptocurrency securely requires an understanding of concepts like those private keys, wallet security, blockchain confirmations. It's not always instantaneous. So this complexity does create friction for adoption. There are all sorts of wonderful Web3, Bitcoin, blockchain adjacent organizations that are solving for this. I do have a slide in the appendix that I can show in a moment that tries to effectively allow folks to have all of the bells and whistles of a NFT or NFT-like experience without all of the headaches of these private keys and managing maybe your personal or hot or cold wallet when you connect things. But yeah, we can get into that. Right. Energy consumption. I touched on that a little bit. So Bitcoin's energy comes from that encrypted energy concept. This is a combination of energy and specialized computing equipment, basically those Bitcoin miners that are distributed globally. They're operating via satellite. There are Bitcoin ledgers being operated on the sea, over water. Again, this has become a thing, or ledger maintenance has become a topic for those folks that are really deeply into Bitcoin and want like a potential lottery ticket. So you can buy small USB miners now and have that potential to solve a block. So if you solve a Bitcoin block, you are rewarded with just under 3 Bitcoin, I believe, currently. So yeah, that's 160 plus $1,000, $180,000 if you solve Bitcoin's block that is occurring every 10 minutes. So we look here at the FTX collapse. That was definitely a moment that caused a lot of headwinds for crypto. Yes, Pat?
Yeah, I'm sorry, Chris. Can you re-explain solving a Bitcoin block?
So basically, what the miners function is in this like checks and balances system that is Bitcoin. Our miners have this specialized software. It originally started as GPUs or graphical processing units in computers. So people are using the compute of their video card to churn through basically a very hard mathematical proof where there's one known answer, and everyone that is maintaining the Bitcoin blockchain is trying to solve this computational proof all at the same time, where their inputs to solving the problem every time they get it wrong is fed back into the system. So everyone's miner is learning from the incorrect answers of others. So folks that have bigger mining operations effectively have a larger chance at solving the block, but does not guarantee that they're actually mining these Bitcoin blocks. What that mining function is doing is just verifying as well that the person that's starting a transaction has the money. So they're verifying on their ledger that they have the money that they're effectively trying to transact against.
Okay, so
It's
and
complicated.
again, my apologies, but you're a very solid presenter and very logical. And I, so when the I am still not processing. It does is the initiation of a Bitcoin block. So, is who drives why it needs to be solved?
Sure.
Well,
So,
you know what,
yeah,
Pat, let me ask this question because that may answer your question. Isn't it just factoring primes, or is that not what it's doing? Is it something much more complex?
I think to simply put it, it is just factoring primes.
Okay.
Yeah, basically, these are, how do you put it simply? Like they're solving really difficult math puzzles, and these puzzles are so hard that they require this extra compute to solve them through trial and error.
So,
So Pat, let,
So they're
Pat, let me.
guessing millions of times per
okay,
second
so
until someone
so
spits out the right answer.
I am seeing a goodwill hunting. Essentially, this is a quiz, a complex quiz that has a solution, and these miners, if you buy a mining uh, product or software, I assume it is a software add-on or whatever it is, then you are investing your time and knowledge of the uh, principles of cryptocurrency and Bitcoin to attempt to solve this puzzle in order to receive a reward, right? A Bitcoin.
You are, so you're doing all of those things, but you yourself are not using your knowledge of anything. It's the computer that's using its compute power to solve a formula. So Pat, you remember what prime numbers are?
Yes.
So
Only
imagine,
divisible by themselves and one.
so imagine you have a number that is 16,000 digits long, and you have to figure out what are the prime numbers that when you multiply them together make that number. That's all, well, it's almost all trial and error.
Mhm.
So imagine a computer that all it's doing is spending its time doing that. It's trying to figure out what numbers, what prime numbers, when multiplied together, give you that number. And it's the kind of thing that it's you it could take millions of years to figure it out. But if you have a little computer that's running and it happens to stumble upon it, well,
Yeah.
good for you. You just made 80 grand or something.
Exactly. Yeah. If your incentive is 3 Bitcoin, how much money are you going to throw at that problem?
Got it. Okay, and follow-up question, and I know one has his hand raised as well, but a follow-up question, are these tools or mining tools that you buy, how do you distinguish the value of
That's a
these?
good question.
That's a great question, because there was a time when China banned mining, and a lot of those rigs were up for sale and getting shipped over here to the U.S., where there was a reduction in compute power in the Bitcoin network. So there was opportunity again for people to use even some lower end, earlier model mining rigs because, yeah, the difficulty of solving problems was reduced because of less computers on the network, basically, or less folks maintaining the ledger at that time. Now there's, I guess, more of a movement for people that just want to fully participate in crypto and Bitcoin, so they maintain a ledger of their own. Some of that participates in that mining function, but again, your odds are very low, and it isn't something that can be purely a software solution today. A lot of this is being accomplished with like a small hardware solution, which is either like a small Arduino computer chip and like a big enough SD card to hold the blockchain or Bitcoin ledger on it. But yeah, it's typically hardware these days. You can join groups, like more mining groups, so you're basically paying for someone that operates a larger mining operation so that you get a share of that reward when they hit the block, or if they they solve a Bitcoin block, which again, that occurs every
Oh.
10 minutes throughout the day.
Yeah, what happens when what happens
Fascinating
when they got it
stuff.
all solved?
And there's only 20. Yeah, exactly. So yeah, that's the interesting thing. Like, what's the incentive then for miners to continue to maintain the Bitcoin blockchain? And that's going to likely be some sort of fee structure, because right now you're getting over three Bitcoin for that block, for that solving the block, basically.
Yeah, but at some point, you're gonna like somebody just put in the chat what happens when quantum computers happen. At some point, don't you? Well, I guess what happens is you solve it, and then what? How the bits the bitcoins that are out there are the bitcoins that are out there.
Right. So
So it's fixed.
the quantum computer conundrum or challenge that more people are afraid of is it going to solve your seed phrase? So like, will there be a quantum computer
Oh
that
yeah.
can reverse engineer? So a wallet holds $10 million. Can I reverse engineer the 12 words to give me access to that wallet? So there are efforts underway currently for this quantum resistant version of Bitcoin. A lot of really smart folks on it, but it's a challenging thing. With something like Bitcoin, you need everyone that participates to agree. So getting any sort of protocol level changes done is almost a near impossibility. Maybe once Bitcoin is again in its six figures and there's more money at stake, people pay more attention. But yeah, the quantum risk is real. I think it's more of a risk to passwords and seed phrases on the blockchain, but that's the same to say with any system. So your 16 character required password with one special character, quantum computing is going to eat through all of that and be able to find every mention of your email address across any platform and feed in brute force passwords as well, following a more simple password paradigm. So I think, yeah, quantum is a risk for a lot of different things tied to our financial systems. But it's not quite here yet.
Chris, about when is it possible that we're going to hit maximum Bitcoin at the current rates?
I think they're pretty predictable. I know that there's several charts. I think it's like around the 2140 time period.
Oh, 20. Okay, so
Yeah.
we will not be around for that.
Yeah, that's too bad. Imagine how much less carbon is going to be put out there when they've solved that.
Well, but Chris just mentioned that you still need to create the
Yeah,
blocks on
right.
the blockchain. So
Right,
how are
right.
people going to be incentivized? I guess that's where I'm going. If you're going to start charging fees, then doesn't this almost just become banking, where it's
Which
kind of
they
like a
already,
bank?
yes, there's already a pretty large fee structure. The U.S. moved a lot of that seized funds into another wallet, and they paid hundreds of thousands of dollars in fees where they didn't have to do it. You can pay a priority so that like my transaction goes through the next available block basically, and you can pay that premium. So like they force your transaction through, and there's front running of that too. So with like NFTs, people are trying to mint your NFT or what have you. So people will try and race you on the blockchain basically and outpay the fees of your transaction to try and sneak one ahead of you basically. So you could pay more fees to like have a more favorable scenario. So yeah, the idea is that it would shift to more of that pure fee market. So they would not receive any new created Bitcoin as a reward. Instead, their compensation is purely from transaction fees paid by users.
Hey, hang on one second.
I think it kind of. I think isn't that going to kind of change how just Bitcoin is viewed or how it's used? I mean, it's not really even used that much as a actual currency at the moment, but if
Right.
it ever did.
Yeah, it mainly means that like mining operations have to change as well. So like those have to be built to be more sustainability focused because they can't rely on those rewards. And then also larger organizations that are purely built off of mining, like Marathon and Riot, will also have to change their business strategy as well. So yeah, I think it's up to the Bitcoin community really to observe if transaction fees alone provide a sufficient incentive. Um, but yeah, there's very little support for folks uncapping that 21 million unit
Yeah.
of
Yeah.
Bitcoin.
Now, in the last presentation, we talked about proof of work versus proof of stake. I'm not sure I totally understand proof of stake, but is there a possibility that that could become the method of verification over proof of work?
I think that's really what sets Bitcoin apart. Ethereum made that move to proof of stake as like a means to really incentivize like a foundational element. So like the Ethereum Foundation having folks stake an amount of Ethereum to allow them to be participants and like actually have a say in how that cryptocurrency evolves. So that was a little bit different. And I would argue that proof of stake may be at more risk of a quantum attack where, yeah, the stake that's being used effectively can be from combined or nefarious places and maybe disrupt how that network operates.
So
Whereas,
it's
yeah,
not really possible to switch from a proof of work to a proof of stake in
they
a
tried to they
particular.
tried to do it. So like early in Bitcoin's life, there was the block size wars where there was Bitcoin Cash versus Bitcoin, where it's like, oh, the size of the block on the blockchain is too small. Like you can't transact fast enough, and you can't have a lot more. You can't have a lot of transactions per block, basically. And so there was a big move to fork Bitcoin, and there was a big movement, and those folks did that. But that didn't end up panning out well for them because in the case of Bitcoin Cash, they lost effectively that trail of history of the original Bitcoin. And then, yeah, folks just didn't have trust in that network. So there was less market participants and validators.
Okay.
So we got here this is some more recent news. So yeah, the past couple of days has been interesting. S&P's volatility with just the tariff talk and back and forth as the S&P is volatile as Bitcoin currently. S&P 500 is down 6% for the week, but up almost 8% on the day. So yeah, it is strange times, and you will see this play out as well in the bond and treasury market. We see Donald Trump talking about if he can remove Chairman Powell. So yeah, we'll see what happens with interest rates as well. But that will all have an impact on what happens with cryptocurrencies and whether or not these are used as a preservation of value. So there is institutional adoption accelerating here. And Michael Saylor declares that Bitcoin is legitimate. So he points to the shift in really recent years with this institutional acceptance. We're seeing more participation from financial institutions, your VanEck, your BlackRocks of the space, creation of different asset types and asset classes around cryptocurrencies as well. So you can see, just looking at the charts, the acceleration of institutional adoption, currently with around 3.15 million Bitcoin held in institutional treasuries. And that ranges from public companies to governments right now. Let's see here. Yeah, BlackRock, Fidelity, and other firms offer different investment products that continue to have record-breaking inflows. Tesla and Block have Bitcoin on their balance sheets. And you have nations like El Salvador who have adopted it as a legal tender. I know that there's been some back and forth there with the IMF on whether or not El Salvador can identify Bitcoin as legal tender. I think they took that off, but they continue to add to their treasuries. So that's still kind of up in the air. These frameworks are starting to mature a bit more, which is bringing, just a bit more clarity to businesses operating in this space. I mentioned earlier that, Department of Justice is no longer, they've closed up their crypto investigation team that is looking at folks that have self-custodied funds. So we'll see how that pans out in the coming weeks, but all news around whether or not you can actually self-custody and what that looks like from like a tax perspective. This legitimacy shift creates a foundation for mainstream adoption that just didn't exist even a few years back. So as these institutional players make it more accessible, whether it's through your own personal IRAs or 401k, they'll just continue to strengthen the position of these cryptocurrencies like Bitcoin, Ethereum. I know you guys talked about pudgy penguins last session. They have Pengu. There's going to be a Pengu ETF by VanEck soon. So even these currencies that are more cultural type coins are something to look at as well. Is Bitcoin the standard? I would say that, Bitcoin is that rising tides, and that's why I'm really focusing a lot on Bitcoin. I have nothing against other cryptocurrencies, and I think there's a lot of opportunity in the short term with some interesting either agentic AI plays, purely mimetic meme coins as well. Like I invest in all of it. I hold too many bags, but I think that's the price to pay. It's kind of like tuition, just to learn about these communities and really what they're kind of doing at that ground level. So this map here is showing the evolution of state level Bitcoin adoption, and specifically strategic Bitcoin reserve. So anything you see here with a orange Bitcoin B is a state that has proposed to buy Bitcoin outright, and not other digital assets. So you may have heard the term strategic Bitcoin reserve as well as digital asset stockpile. There's a lot of these terms being tossed around currently around just about how these things will be custodied and reflected back on balance sheets. So I think what's particularly interesting about this, though, is that there's a pretty nonpartisan nature of this adoption. So both traditionally red and blue states are exploring Bitcoin reserves as a hedge against inflation and as a way to potentially meet budget deficits. So when we think of currency debasement, that's why a lot of these strategic Bitcoin reserve proposals are being considered. And this is, showing a different type of distribution between public companies. So I keep showing Michael Saylor. You can just see how much his company has invested their treasury, and any recent preferred stock issuances, debt issuances. He's been able to put out $2 to $4 billion of new issuances at a 0% rate. So he's basically borrowing money for free and just buying a ton of Bitcoin. And you'll see other companies doing that as well. And so, I think what's interesting here in the conversations that Michael Saylor was having with companies like Microsoft is how their treasury, or folks that are sitting on a lot of cash currently and have these forward-looking projections or forward-looking valuations placed on their organization, may have a better opportunity investing their cash positions into Bitcoin and just being able to hedge their currency any currency debasement or potential inflationary risks by investing in Bitcoin. And so, yeah, really, I think he's hedging on that network effect to just further legitimize Bitcoin. But yeah, there's something to be said there about companies finding success in that approach. This is the US's known allotment of different cryptocurrencies. You'll see that a large portion of this is Bitcoin, 98%, roughly 98% of their holdings. And yeah, this is something that Trump recently had mentioned about there being a reserve and that seized funds would be moved into this reserve. No talk of purchasing Bitcoin just yet. A lot of this is from seizures related to Silk Road. Ross Ulbricht, who was recently released as well. So it'll be interesting to see how this pans out and if there's any conversation around what Senator Loomis is proposing, converting gold to Bitcoin. So this is an important IMF doc that just came out recently as well. Here you see that there's really like an excerpt from this balance of payments manual where they're saying that Bitcoin is really designed to be a digital gold. And so there's starting to be more of this conversation even at the international level as well. We see here that countries like China and Russia, this is just reported a couple of days back, are now settling energy trades in Bitcoin. So how much of this is happening, I haven't been able to dive too deeply into, but VanEck, a $115 billion asset manager who's really deep into Web3 and providing these more crypto forward investment vehicles, is pretty attuned to what's going on there. So interesting to see this happening. See a question come here about Bitcoin being decentralized with institutions increasing in it. I think so. So the decentralization comes from people maintaining that ledger. And again, that block or that Bitcoin ledger is so like decentralized to the point of like there's folks that run multiple Bitcoin nodes in their home just for the sake of continue like for the Bitcoin purpose, like for the purpose of supporting Bitcoin. So I think it will continue to be decentralized. It would take a lot of, I suppose, virtual machines or other hardware to be created in a way kind of deceptively for it to become a more centralized thing. If we go back to this chart here, you'll see that, there are countries that this is concentrated within. And I think that's where you're going to start seeing this race to acquire more Bitcoin. It's interesting, countries like Bhutan and El Salvador have a continued publicized amount of Bitcoin that they're either mining or purchasing outright, where other countries like North Korea have been involved in more publicized scandals. So like you might have seen the Libra coin out of Chile more recently and the max extraction that happened on the Solana network. That was tied back to North Korean hackers as well. So as much as it's becoming decentralized, I think centralized around certain countries, I think there's still a big decentralization effort, and that the transparency is something that will keep it that way. Okay, yeah, so this is where we're talking about that 51% attack. I forgot I had a slide about this, but so Bitcoin being that proof of work network and protocol that requires specialized mining equipment to solve those math problems comes at a large distribution of energy and electricity as well. So this ties into the fact that folks that are truly maintaining the networks are spread across the globe to those areas where electricity either comes free or can be repurposed. So you may have seen even in like New York City, there are bathhouses that are powered by Bitcoin mines now where they're repurposing the heat. So if you can find a way to use the excess energy to offset your costs, there are now fancy bathhouses in New York City powering hot tubs and pools of water just run off purely off Bitcoin mines. So there are more decentralization of this energy usage as well. And you can just see how it is currently concentrated in the US, but still spread really across the globe. This little legend at the bottom here is showing you the compute or hash rate available in this country. So all the countries with any tint of color currently have a known mining operation. Talked about the remittances use case. So El Salvador has been able to reduce their costs from 10 down to 1%. A person sending $200 from the US to El Salvador might pay $10 to $20 using Western Union. But currently, due to the wider adoption of like Bitcoin Lightning and just Bitcoin in general, that fee is less than $1. Yeah, banking the unbanked. We talked a bit about that. Some supply chain transparency. So this is really focused at reducing fraud and increasing efficiency. Companies like Walmart have implemented different blockchain solutions to track food products from farm to store, really allowing them to have more precise recalls in different areas and then, yeah, address any safety issues that arise more quickly. Talked about smart contracts a bit. Really, this is going to be crucial to automating more complex transactions that require multiple intermediaries. Things that come quickly to mind are, again, those insurance products and like claims processing. And lastly, cryptocurrency serving as that inflation hedge for unstable economies. So when local currencies are rapidly losing value, Bitcoin and other stable type currencies provide that alternative store of value. Yeah. Don't have to drain this one too much, but yeah, traditional finance still continues to excel in a lot of scenarios. Our day-to-day is still functioning. Speed and convenience of credit and tap to pay still very much there and unmatched in developed economies. There's relative stability to major currencies as well. So something like a 30-year mortgage denominated in Bitcoin might be impractical due to volatility. But we are seeing these products starting to come up a bit more where you can effectively have a Bitcoin-backed mortgage and explore those type of products. There are more consumer protections for fraud and disputes in traditional financial services. We touched on that with legal recourse, I think being the main one here, where their courts understand bank accounts and loans. Investment products where legal framework around cryptocurrency is still pretty much up in the air by comparison. Question. Absolutely. And some people may not know when they are using crypto these days too. So just like I would say, I don't know exactly how email works, and I'm less familiar with the SMTP protocol that email operates on. I think people are going to start using crypto products or are already using crypto products. I know a lot of luxury goods use a crypto verification NFC tag these days. That was a world I was in just prior to my last employer. Yeah, there's a lot of track and trace technology being put on chain, and really to protect against fraud in the shipping pipeline, but also diversion of shipped goods as well. So some goods that are meant for one market end up in another, and that can cause a lot of issues and problems. So there's interesting applications of blockchain across the board that aren't necessarily tied to the money aspect or the streaming of money. But yeah, I see more folks sticking to traditional finance, But I do also see people diving a lot deeper into faster settled cryptocurrencies like a Solana blockchain for the pure casino aspect of it, where you can invest $1,000 and maybe lose on 9 bets, but 10,000x on another. So that's attractive for a lot of people. And when the tax landscape isn't fully defined yet and it's purely unregulated, people are willing to accept some of those risks. Right. And so we see this emerging middle ground, which I think a lot of folks tend to be in now, where it's like there's some interest in digital currencies. I know my nieces and nephews use Robux or whatever, Roblox dollars and V-Bucks and Fortnite. They spend hours dressing up digital avatars, but wear whatever. They go out of the house in their pajamas. Like, it's another world, and the digitally native folks will probably be a bit more adept to these currencies. There's already a lot of talk of Grand Theft Auto 6 having a digital economy with a currency built into it. People today already make a living off of Grand Theft Auto 5 and selling skins within a closed economy. So we're only going to see this starting to grow with respect to non-fungible tokens and online personas and pseudonymous users. Like when you start building these profiles up and having more of that digital identity, some of these things become tangentially more important. So yeah, we're seeing institutional adoption, banks offering different crypto custody services. Some banks are offering to spin up a wallet for you. And so as the regulation starts to evolve around this, I think we're going to see more banks wanting to offer more user-friendly options that may come with insurance, which would be wonderful. But for all intents and purposes of crypto today, there is no chargeback functionality. You get one letter wrong on an address you're sending to, there's typically no recourse. And so, yeah, there are these hybrid approaches that are interesting and emerging. I think one of Michael Saylor's more intriguing concepts is framing Bitcoin as that digital energy network and an emerging solar system. So Bitcoin is not a simple Metcalfean network where the value increases with the square of the number of users. Instead, it functions as a Newtonian system with gravitational dynamics. When someone brings $1 billion to the network, it matters. When they bring 10 billion, it matters even more. The more capital and energy that flows into the network, the greater its gravitational field. And so that we've been seeing this as he continues his march in convincing organizations to get some skin in the game, put some dollars of their treasury into Bitcoin. So eventually anyone in orbit has to adjust their trajectory to accommodate that gravity field. You see this thing coming to life in front of you, it's going to have Newtonian dynamics. So he's saying that as Bitcoin grows, as it really has continued to grow, I've read so many different Bitcoin obituaries and given various versions of this presentation. It'll continue to absorb other cryptocurrencies over time. A lot of that extraction that we saw from Solana, those wallets converted that currency to Bitcoin because Bitcoin has been that store of value and that rising tide, really, where folks see it as an opportunity or as that digital gold. So whether you accept this cosmic metaphor, I think that it provides an interesting framework for understanding Bitcoin's growing influence on really the broader financial landscape. And as more capital continues to enter the system, that pull becomes stronger. So these future projections are really stark. You can see Bitcoin as a store of value is small $2 trillion blip on this board here. Something that Michael Saylor argues is that Bitcoin deserves a $280 trillion piece of the pie, and that a lot of this is going to come from some more antiquated stores of value, such as like real estate, where people are loaded up on real estate and don't have the ability to, say, move that across lines. Say you invested heavily in an area that's now prone to forest fires or earthquakes, or has a receding shoreline. Those investments tend to be a bit more risky now than something like a Bitcoin that is starting to prove to be a bit more stable in a larger asset class. So if Bitcoin were to even capture a modest portion of these other asset classes, particularly for money, bonds, or gold, that the growth potential is really significant. And if Bitcoin were just to capture 10% of gold's current market, that alone would be a 4 times increase in price. So that's worth a lot of these crazy valuations that you hear folks saying $150,000 Bitcoin, $1 million Bitcoin may not be so far off. I mean, I've bought Bitcoin at $200 a Bitcoin. Like it has grown far beyond anything that I expected, and it's certainly something that I can't ignore. So I try and uh, share and advocate for it as much as just something to pay attention to, and certainly not something to go all in on, put all your eggs in one basket. But at the rate that it's growing and the resilience that it's shown, there is something there to consider. So yeah, as we conclude, definitely want folks to make informed choices, emphasize that traditional currencies and cryptocurrencies both have legitimate strengths and weaknesses. Different solutions work better for different problems. And for some use cases like international remittances, cryptocurrency offers clear advantages. For other things like stable long-term planning, say saving for college, traditional currencies provide better foundations for that. Just understanding some of these traditional trade-offs help drive better decision making, and recognizing the strengths and limitations of each system can help you make better, more informed decisions in whatever situation you find yourself in. So yeah, just consider your risk tolerance when engaging with either system, your personal financial situation, all those things, and to see what makes sense for you. And certainly do your own research. Check with folks. Happy to connect with any of you all. But yeah, I think that focusing on fundamental properties that we talked about here, like those haven't changed. And I think that's what has made Bitcoin this resilient, is that this is all programmed and in the code, whereas a monetary policy or monetary system is applied based on scenarios. This operates kind of as a dumb protocol. It does what it was set out to do. You can jump to Q&A. I have some interesting appendix stuff. So this is the chart showing the amount of sustainable energy being used now across Bitcoin's known mining operations. We have here. This is a newer integration that allows users to link any address from these ecosystems. So these are different blockchain platforms across chain, basically. So if you have an NFT on Ethereum and you want to provide access to someone that only holds Bitcoin to exclusive event or club you're going to, ColdLink has seemingly solved for that and has provided a lot of pretty interesting APIs. This is relatively new, I would say, soft launched within the past month. So they're starting to see solutions built around this that don't require you to have so much crypto knowledge. And for folks that are, say, operating on a more traditional social platform, allow you to some exposure to those like wallet only features or things that come with custody and ownership. Anything else? I think that's it.
Excellent. Thank you, Chris.
Absolutely.
Does anybody have any other questions, comments?
Yeah, I would only say this has been fascinating, Chris, and you're a really engaging speaker. So thank you so much.
Thank you all for having me. I'd love to talk about this topic. I feel like there's so many different rabbit holes that one can go down depending on use case or even whichever blockchain. I think that there's compelling communities and builders, investors across all of these environments. But it's really focused on finding those bright spots and trying to suss out, where there might be nefarious activity or something that's too good to be true. So don't
Well,
trust guaranteed
you,
returns on anything. Don't trust anyone saying that they're gonna 10x you on anything, because
yeah,
that's never certain.
well, that's the case in life in general.
Absolutely.
So, but I will say you provoked my thinking on traditional financial systems and their susceptibility to a given political uh, environment, a social environment, a financial context or environment. And I do think when you consider the complexity of the financial markets globally and in these evolving nations, as well as your point on how many are over 8 billion people are not in the traditional banking system. This is of has to be considered a potentially feasible alternative.
Absolutely. Absolutely. And that's something to say too, where here in the US, it's challenging for even young adults to open up their own bank account, for instance, where nowadays you can spin up a wallet pretty quickly and start participating in different economies very fast. And you get in early, you participate with a group that, say, airdrops you a token or allocation that surges. All of a sudden you have wealth and can participate in new ways. So I think it's a nice entry point as well for folks new to money, new to finance.
And frankly, when we speak of nefarious transactions, God almighty, there are many in our traditional financial system. All of these islands set up, and for that matter, European nations set up to hide assets and cloud transactions and obfuscate the intention.
Exactly. Yeah, a lot of what the blockchain enables is to really prevent or give transparency to shell company type operations and allow you to follow the money. I think that in a world that preserves privacy, that's a super huge feature and value add.
All right, folks, we are about at time. Thank you again, Chris. This has been very good, very interesting. I will be posting the recording on ITKAN's YouTube channel, and I'll let all of you know when that happens by email. And Chris, if it's possible, if you could share the deck with us. If not,
100%.
totally understand.
I'll get the deck over to you. We got to clean up some of the speaker notes, but I'll get that over to you.
Sure. Yeah.
Sure.
Thank
right.
you, Chris.
Of course.
Thanks,
Thank you all.
Brian. Thanks, everyone.
Take care.
you.
Have a
All
great
right.
evening.
Take care. You too.
Bye.
Bye.
Bye.